Okay, welcome back. We're doing the second part of chapter 1. Now, I'm actually kind of doing this a little bit out of order. Financial statements don't come to later, but in my way of explaining it, I prefer to teach the financial statements before business transactions. I feel like you need to know what are the big picture items, and then we can see how do we put information on those statements, and that's what transactions are. So we have 4 financial statements: the income statement, the statement of owner's equity, balance sheet, and the cash flow statement. Let's go ahead and jump in and take a look at these. So we have the 4 financial statements, and the first thing we need to know is that they need to be done in order, or at least the first 3. The fourth one needs to be done at the end, but definitely the first 3 are tied together. Those were the original 3. The fourth one, the statement of cash flows, wasn't brought in until later, and we'll talk a little bit about that here in a second. So the first 3, we'll start off with the first one. You need to do the income statement first. You need to prepare the income statement first. And just in broad strokes, what is on the income statement? Revenue. That's the money we get from customers. Customers pay us money, and that's revenue. Now, all the things necessary to generate that revenue, we call expenses. They could be rent for our office space. It could be wages. It could be inventory that we sold them. These are all expenses. Anything necessary that cost us money to generate the revenue are called expenses. And the difference between our revenue and expenses, well, in common terms, we call that profit, but in accounting world, we call that net income. And the idea of net, whenever you see net in accounting, it means we're typically taking a positive and negative number and seeing which one is the stronger. So if the expenses were bigger than the revenue, this wouldn't be net income. This would be a net loss. So net just means putting a positive and a negative number together and seeing which one comes out. The second one, so we do this one first because we need to calculate net income. The second one is going to be let's see, I think they call it owner's equity statement or statement of owner's equity. I will just abbreviate it, owner's statement of owner's equity. And what do you have? This is the owner's investment in the company. So we start off with the owner's capital at the beginning of whatever the period is of the year, of the month, of the quarter. So this is beginning. Then we're going to add in any new investment that the owners put into the company. And then we're going to add in the net income. That's why we have to do the income statement first, because we can't do the statement of owner's equity. We can't calculate this until we have the number for net income. Then we're going to say take out any drawings, and I'll explain that here in a second. And that will leave us with owner's capital at the end of the period. Now, first thing I want to say is drawings are anything taken out of the company's profit for this year or previous years that they want to pay to the owner. So the company can give profit to the company, pay it out of the company to the owners, and we call those drawings. As we get further on, we'll call those dividends a little bit later. Net income, you can see that there is a beginning amount of capital. That's all the profit that we didn't pay out in previous months or previous years. And then each year we add in that year's net income. So you can think about the owner's capital and net income as it's sort of the piggy bank for the owners. The owners take the profit and they can do one of 2 things. They can reinvest it in the company by not taking any drawings. They would just leave the net income in the owner's capital, and that would increase the capital of the company, or they can take it out. But that's the owner's piggy bank. They can leave it or take it as they wish. Obviously, they can't take more drawings than the total combined of all this year's and all the previous year's net income. But think about net income as profit, but also it's the piggy bank for the owners. They can take stuff out of that. The last one, or the third one, but the last one of the main 3, is called the balance sheet. And it goes according to this: assets equals liabilities plus equity. And owner's capital is a part of equity. So you can see We can't do the balance sheet until we know what owner's capital is, the ending balance. And we can't do the ending balance until we know what net income is. So we need to calculate the income statement first, statement of owner's equity second, and then the last is the balance sheet. And we'll go in a lot more detail into this assets equals liability plus equity. The third thing, or the fourth one, is called the statement of cash flows. And what ended up happening is after many, many years, these three tied together very well, and typically was very good information for investors to see what a company was doing. But over time, they realized that the one main thing that these other three were not telling them, or were not showing very clearly, is what is the cash position of a company. So there is some cash in the assets, but it doesn't tell us kind of where it's being spent, how it's going up and down. All it does is it just tells us what's in the checkbook at the end of the year. We don't have a real good view of all the ups and downs and in what areas of the company the money is being spent. So after some amount of time, they realize they need a fourth one, because there's a phrase in business where we say cash is king. And because of this, we need to know what it's very important for us to know how the cash is being used in a company. So we won't go into too much detail here. Just realize that we're going to take the cash at the beginning of the period, of the year or the quarter or whatever, and we're going to look at the pluses and minuses of the cash usage in three areas: operating activities. So we'll say plus or minus. Did it go up or did it go down? Actually, I'm going to put investing activities. Plus or minus. And the last one is financing. Spell that right. Financing activities, plus or minus. So we say, what's the cash at the beginning of the year? Then we either use cash, or we use cash, or we took in cash for these three different areas, and that should end us up with what is the cash at the end of the year. And that's comes off of from the asset side, is what is the cash at the end of the year. Now, operating activities is a little bit more straightforward. It's just your day-to-day running your business. What are you doing with inventory, with employees, with rents, utilities, all that sort of thing. All those sort of things fall under operating activities. Now, investing and financing on the surface seem like the same thing or very related, but as far as the statement of cash flow, they're two very different activities. Investing relates to what we call long-term assets, or generally towards long-term assets. And what do I mean by that? So all these short-term assets like inventory, etc., those are things that are handled in operating activity. But sometimes you have to have a building, or you have to have equipment, or maybe you purchase land. There's a whole bunch of long-term assets that you're not really buying and selling, but you need to have to run your business. And so investing is basically saying, how well are you maintaining those assets? In other words, are you allowing your factory to run down to where it's almost ready to be replaced? Are you letting your equipment run ragged? That's bad for business, because if you let your equipment run ragged and then you have to buy all this new equipment, or it breaks down and you've got an interruption in business, that could affect your operating activities. So the idea is, hopefully you're making a lot of cash from operations, and you're using some of it to reinvest back in the company to maintain your long-term assets, to maintain your building, to maintain your equipment, et cetera, et cetera. Financing is slightly different. That's maybe a little cyclical. I hope that's right. It's basically if you need cash. So sometimes you have projects that you need to borrow cash and you go get a loan. Sometimes you're in a cycle to where, okay, we've got a little bit extra cash, we're going to pay off some of our loans, or we're going to issue stock or something like that. So financing is just wherever you are in your part of your business cycle that you're trying to determine, okay, I may need a little extra cash to run something that I'm doing. And that's fine. So investing and financing, so we could say, investing is dealing with long-term assets, and a lot of times financing is dealing with long-term liabilities or perhaps stock. Okay, so I want to point out, when we go back up here, So these are the financial statements. This is where we're putting this information. Now notice we've got these three up here plus the statement of cash flow. Now, why were these first three very important? Or how did they determine that these were going to be the three? If we take a look at these things, we can see, and it's maybe not obvious at first glance, the income statement, revenue, that's the money we get from customers. Expenses, that's all the sort of day-to-day operational things that we do to generate revenue. So we could say this particular statement deals with, it allows us to see at a glance what we're doing or how our business is doing with our customers, right? What money are we making from our customers? How much are we spending to make that money off, to make that revenue? The statements of owner's equity, if you're kind of seeing the drift where I'm going, this one's a little easier. This tells us all our dealings with the owners. Did they leave the money in the company? Did they reinvest it? Did they take some money out through drawings? Now, less obvious here is the balance sheet. So assets are things that the company owns, right? Liabilities, think about them like obligations. Like if we had a bank loan, we'd have to pay that bank loan. So these are things that we owe. And the equity part is the owner's part. So notice, well, maybe it's not easy to notice, but we'll see a little bit later on. Assets don't pop out of just out of nowhere. They either come from, we got investments from owners, or perhaps we took out a bank loan. In other words, to get those first couple $100 or however much startup money had to come from somewhere. Assets just don't come from nowhere. So we could say, or at least I do, is I say the balance sheet tells us everything we need to know, or a lot about what we need to know about our dealings with our business partners, right? So it could be, we owe wages to our employees. We bought stuff from a vendor and we haven't paid them yet. That would be a liability. We have a bank loan. That would be a liability. Also, all of our assets, if we own land, all those sort of things, and then all the things with our owners. So at a glance, someone who's very knowledgeable about financial statements, if they wanted to know a specific thing, they would know kind of where to go. If they wanted to know about what the business is doing with customers, they go to the income statement. If they want to see how they're situated for the long term, dealing with their business partners, they would go to the balance sheet. And so those are the important things. And the last thing I want to mention before we bridge over to the last part of chapter 1 is within these things, these are the financial statements. These are the summary of all the transactions that's happened before. But if we wanted to start recording transactions, which we'll look at next, we need to know, well, how do we do that? Well, we focus on something called accounts. I mean, it is called accounting, isn't it? So there are different things called accounts. We've mentioned a couple of them: cash, a bank loan. Those are types of accounts. And there are actually 6 types that we track. There are 6 sort of general categories of accounts. There are assets, that's 1. There are liabilities, that is 2. Equity, revenues, expenses, and drawings. And like I say, we typically, once we get a little bit further on, we're going to call these dividends. Okay, well, that is the financial statement part. Let's go ahead and move on to the business transactions, and that will be the end of chapter 1.